This video will walk you through the solution to exercise 14-20, which focuses on future income taxes under ASPE. Here's the data for our problem. Salmon Inc. reports under ASPE and has chosen to use a future income taxes method. It's reporting the following regarding its income taxes. Items here include accounting income for the year, depreciation, capital cost allowance, etc. Note, the rent revenue collected in advance represents an amount prepaid by a tenant for the next 2 years. Rent is earned at the rate of $4,000 per month, is collected on December 31st, 2026, and is taxable when collected. Also note that the company commenced a single construction contract during the year. Contract revenue has been reported using the percentage of completion method, but the completed contract method is used for tax purposes. The company expects the project to be completed in 2027. Finally, there are no other temporary or permanent differences aside from those identified above. The current tax rate is 30%, which has been in effect for several years. There are 3 requirements for this problem, so let's begin with requirement A, which asks us to calculate the current and future tax expenses for the year ended December 31st, 2026. We'll begin with the reconciliation from accounting income to taxable income. So we always start with the accounting income, or accounting profit in this case, of $150,000. We would normally add back or subtract any permanent differences, such as 50% of meals and entertainment, 100% of the golf club dues, or subtract any non-taxable revenue, such as dividend income. This problem has no permanent differences, so we can leave that blank. And then we'll start to adjust for our temporary differences. First item is the unearned rent revenue. So the company has received on December 31st, 2026, $96,000 in prepaid rent from a tenant. That's 24 months at $4,000 per month. The company is going to recognize that in accounting income over the next 2 years, but for tax purposes, it's taxable when collected. Therefore, we must add the $96,000 in rent received from the tenant to our accounting income to arrive at taxable income. The next item is the construction project that has been undertaken. $90,000 of the contract has been recognized as revenue for accounting purposes. However, the company uses the completed contract method for tax purposes. Therefore, we must subtract from accounting income the $90,000 in contract revenue that has been earned for accounting purposes to date. The last item to adjust for is the difference between any depreciation expense and capital cost allowance claimed for tax purposes. We know during the year, the company had depreciation charge of $12,000, and the company claimed capital cost allowances for tax purposes of $16,000. So what we must do is add back $12,000 in depreciation to our accounting income, and then subtract the $16,000 in capital cost allowance claimed. That's a net reduction in accounting income of $4,000. Now we can determine what our taxable income is by taking the $150,000 accounting profit and adding or subtracting the temporary differences to arrive at taxable income of $152,000. We apply the 30% tax rate to end up with current tax payable of $45,600. Now let's move on to determining the future tax expenses for the year. The easiest way to do this, I think, is to set up a table. And we'll begin with our property, plant, and equipment differences. So I'll list the year 2026. The item we're looking at is property, plant, and equipment, or PPE asset. And we'll start with the tax basis, or undepreciated capital cost. This is the current carrying value of the property, plant, and equipment maintained for tax purposes. The ending balance for the year 2026 is $119,000. And we can confirm that amount by taking the information provided, where we have the beginning balance of $135,000. And then we know that the company claimed $16,000 in capital cost allowance. Therefore, $135,000 minus 16 is an ending balance of $119,000. Then what we do is we subtract the accounting basis. The accounting basis is simply the carrying value on the company's balance sheet. So if the beginning balance was $120,000, the company then deducted $12,000 in depreciation expense for the year. That results in an ending property, plant, and equipment carrying value on the balance sheet of $108,000. Now notice the way I've constructed this table is that any positive amount would be a debit and any negative amount a credit. When it comes to property, plant, and equipment, neither the tax basis or accounting basis can ever be negative. They're always debits, because otherwise that would imply that you have a negative property, plant, and equipment asset, which is impossible. We calculate the difference between the two. So we take the tax basis of $119,000, subtract the accounting basis of $108,000. This results in a temporary difference for property, plant, and equipment of $11,000. This is still a positive amount, so it's a debit balance, which implies we will end up with a future tax asset. If we multiply that temporary difference by the 30% tax rate, this results in an ending future tax balance of $3,300. Again, a debit. Then we need to subtract the beginning balance, future tax asset for PPE. Now, this question doesn't specifically provide us with what the beginning balance is, but because we know what the beginning balance of the tax basis and carrying value amounts are, we can determine that. The tax basis was $135,000. The accounting basis was $120,000. So if we take $135,000 minus $120,000, that's a $15,000 debit difference. We multiply by the 30% tax rate, which is applicable to all years. That results in a beginning balance future tax asset for PPE of $4,500. This means then that to go from a beginning balance of $4,500 debit to an ending balance of $3,300 debit, we need a credit adjustment of $1,200. So we would credit the future tax account for PPE for $1,200, and to make a journal entry balance, we would debit the future tax expense on the income statement. Next, let's look at the unearned rent. We'll start with the tax basis, and for all items other than property, plant, and equipment, the tax basis can always be zero. Then what we do is we subtract the carrying value of unearned rent on the company's balance sheet. That's $96,000. The company received the cash and would set up an unearned rent liability account. That unearned rent revenue account is a credit balance because it's a liability, which is why I'm entering it as a negative balance in the table. So if we take zero tax basis minus a negative $96,000 accounting basis, that turns into a positive difference of $96,000. If we multiply by the 30% tax rate, this gives us an ending balance in a future tax account for unearned rent of $28,800 debit, which means that this is a future tax asset. And the reason why is because the taxes are paid when the amount of money is received, not as the rent is earned over time. So in essence, the company has prepaid its taxes, and this timing difference will slowly be reversed when the company calculates income taxes for accounting purposes over the next 2 years. We'll subtract the beginning balance. Now the beginning balance is zero since the unearned rent was just received, which means that in order to end up with a future tax asset balance for unearned rent of $28,800, we must debit the future tax account for unearned rent for $28,800. And to make a journal entry balance, we would credit future income tax on the income statement for $28,800. And last is the construction in progress. Again, the tax basis is zero, and we will subtract the carrying value of the construction in progress account carried on the company's balance sheet. That's $90,000. And it's a debit, since the construction in progress is usually a debit balance. When we take zero minus $90,000, we end up with a negative $90,000. This now implies that we're going to have a future tax liability associated with the construction in progress. If we multiply by the 30% tax rate, that's $27,000. That's the ending future tax account liability balance for construction in progress. Now, this should make sense because the company uses the completed contract method for tax purposes, and all the taxes paid on the revenue will be when the contract is complete. The beginning balance for this is zero because the contract was just undertaken during the year. Therefore, the adjustment necessary to arrive at an ending credit balance in the future tax account for construction in progress of $27,000 is a $27,000 credit. And to make the journal entry balance, this results in a $27,000 debit to future tax expense on the income statement. At the end of the day, we can add up all of the future tax asset and liability accounts to end up with a net future tax asset of $5,100. The beginning balance is $4,500. The adjustments for those accounts are $600, and the net expense to the income statement is a credit of $600. For our income statement presentation, we'll show a current income tax expense of $45,600, offset by a future tax benefit of $600, resulting in net total tax expense of $45,000. Now we can move on to our second requirement B, where we are asked to prepare the balance sheet presentation of the tax amounts on December 31st, 2026. So under ASPE, we have to be careful to make sure that we properly classify our future tax amounts as either assets or liabilities and current or non-current. So let's start with assets. Based on what we have, at December 31st, 2026, the company will show a non-current asset for future income taxes for $17,700. And that's a combination of two items. The first is a $3,300 debit balance for the future tax account for property, plant, and equipment. And then we add to that 50% of the unearned rent future tax asset of $28,800. So 50% of that is $14,400. The sum of those is $17,700. Then for liabilities, the company will have its current income taxes payable of $45,600, and that comes from our reconciliation from accounting to taxable income, and that was in the first step. And then the company will have current liabilities for future income taxes of $12,600. And that's comprised of the $27,000 future tax liability related to the construction in progress, which will be completed next year. Therefore, that amount is current. And then we offset that by 50% of the unearned rent future tax asset, which was $28,800. 50% of that is $14,400. Now, because the rent revenue is recognized over the next 2 years, 50% of it is current and 50% of it is non-current. So that's why 50% of it was added to the future income tax asset account. That represents the reversal of the future tax asset that will happen 2 years from now. And the current 50% offsets the existing future tax liability for the construction in progress. Under ASPE, we can only report either a current asset or current liability, and we can net current assets against current liabilities, which is what we've done here. Our third requirement C is to repeat parts A and B, assuming the company uses the taxes payable method instead of the future tax method. With the tax payable method, in essence, the company does not record any amounts related to future taxes. So all that we will see on the income statement is the income tax expense of $45,600. And we saw that in the reconciliation to taxable income. On the balance sheet, we will only see the current liabilities of the income taxes payable of $45,600, and no future tax amounts are recorded or reported, which is what makes this method very, very easy. And that's it. We're at the end of this problem.